Mark, the stories that seem to be dominating the headlines today, at least, are that Trump is winning his trade war. And I think, probably important that we define winning. But I think from one perspective, I would describe it as winning. And I would say that I'm fairly surprised in one perspective, which is the president has seemingly successfully implemented some of the highest tariffs on imports into the United States in close to 100 years without significant retaliation from other trade partners. So from that perspective, I can call it a surprising, and I'm not going to say good outcome because that kind of depends on your perspective. If you're an importer, you're not terribly happy about it. But I think a surprising outcome here is that, they have implemented tariffs on Vietnam, the UK, all of the European Union, Japan, and by and large not seen mass retaliation from those countries in terms of reciprocal tariffs on U.S.-made products. The question of whether or not we're winning the trade war, I'm not sure how to define that.
Yeah, countries don't compete. Companies compete. Let me start with that. And that may not seem intuitive. You probably have not heard that. I probably wouldn't have believed it before I learned about this stuff. Countries don't compete. Companies compete. This is not the era of the gold standard where Spain sends a galleon to collect a lot of gold from Brazil or some crap. Forgive me, but I'm making light of mercantilism, but you know what I mean. The name of the game here is not to collect more gold in France.
Right.
Okay? This is not 1710. Name of the game here is highest per capita GDP, and high per capita GDP, that's gross domestic product growth rate. And the way you do that is to do what you're good at. The fancy name for that is focus on your comparative advantage, things that you're relatively better at producing.
For Chile, that would be copper.
Right.
For
Chile
United
sends
States,
us
it seems to
copper.
be,
We send Chile BCG consulting services.
I was going to say, for the United States, what is it? Like a financial innovations
mainly it's
and
a lot
services?
of it's services now. Like we have a big services surplus with Europe. A goods deficit, but a services surplus. You add those two together, and our trade balance with Europe is about even. So going into this, there were very low tariffs on U.S. exports of manufactured goods to Europe, on the order of about 1%. Paul Krugman, a famous international economist, writes this morning. Balance of trade was close to even. Our exports to Europe are about 90% of our imports. Our companies operated freely in Europe, Krugman goes on. Hundreds of billions of years in profits, we all know. European corporations were, because we have a slight goods deficit with Europe, sending those dollars we sent abroad back to us in the form of $150 billion a year in investments. This was last year. How are we better off paying more for what we need or what we choose to import from Europe is the big question.
Yeah, I guess the potential answers to that question would be, does employment increase as a whole? Does employment in the United States increase? It's tough to measure this without a counter.
Yeah, what is your metric here? That's
right?
That's a good way to put it.
Does employment increase? And I don't just mean manufacturing employment. I mean, because there will be losses in other areas. So does employment increase? It's tougher to measure other things like, we are in a fiscally better place in the United States compared to the absence of tariffs because deficits would have been larger.
Well, then that means again, all these goals are somewhat in tension, Mike. If the objective is to move manufacturing back here, that means that people are not consuming foreign goods. They're consuming domestic goods. That means you're not raising revenue because you're not collecting tariffs on them.
My point with all this is I have a tough time measuring what the success story or narrative is. Like, we talked about how do you measure a successful Trump 2.0 economy, and we came up with a bunch of things. I have a tougher time coming up with those things in the case of a trade war. But what I can say is that investors of all kinds have been, I think, pleasantly surprised that the U.S. has been able to, or U.S. investors at least, have been surprised that the president has been able to implement this degree of tariffs, which, to be clear, are the highest since the 1930s, without sparking an escalating trade war to this point.
Mike, the crap hit the fan in April when we were at higher than these levels, twice, three times these levels. These levels are still extreme. They only look slightly less bad. So investors are maybe breathing a sigh of relief, and the public more broadly breathing a sigh of relief because it's not
as bad as it was in April.
self-inflicted wound, like we were on the verge of committing in April?
Yeah,
I don't.
I think that's the reset of expectations, right? That was a broad expectation, was for a horrible self-inflicted wound, and instead we are in a place where if they stay at 15 to 20%, the tariffs might be manageable for most businesses and consumers.